Analysis of financial statements. The purpose of accounting is to provide meaningful information both to management internally in the business as well as other interested parties externally or outside the business. Financial statements must therefore be very carefully analysed and relevant comparisons made with previous year's results, the ratios and calculations of similar businesses, as well as with the goals that the business is trying to achieve. This will then help the management of the business to understand how the business is performing and what decisions they need to make in order to improve performance. It also helps analysts and possible investors, as well as existing owners, to understand the investment in this business and determine whether they should be happy or not. The first thing that we need to look at is the analysis of income and expenses as shown on the statement of income. These are used to determine the operating efficiency of the business. In other words, how well it is run and managed. The first thing that we will look at is to check the markup that has actually been achieved by the business. This can be done using two ratios. The first one is the one that is most commonly used in reality. This is the percentage gross profit on sales, otherwise known as the gross profit margin. However, you will probably be more familiar with the percentage gross profit on cost of sales. This, in fact, is the actual markup that has been achieved by the business. If you compare what you actually achieved to what you thought the business was intending to achieve, you can determine if there is reason to investigate further. For example, if you actually achieved a markup that is much lower than that was intended, is there a good reason for this? Well, if you were offering a lot of trade discounts, which would result in lower sales, then yes, it's acceptable. However, if there were no discounts allowed, it is an indication that something is wrong. Perhaps the selling price has been incorrectly calculated, or if you are using the periodic inventory system, it is possible that stock has gone missing. In reality, however, this ratio is hardly ever used, and instead, businesses rely on the gross profit margin to determine what they are looking for. One can also look at the operating profit as a percentage on sales. This tells you how well the business has been managed or run, as it looks at the profit that is earned for the sales that have been achieved. The net profit percentage on sales, or profit margin, is quite an important one for investors. They are interested in this in order to determine how much of a return they are likely to get. Lastly, we need to look at the operating expenses margin, or operating expenses as a percentage of sales. Remember that the term margin simply means on sales. In this case, our operating expenses margin tells us how well costs have been controlled or managed within the business. Remember that this is vitally important, as every cent that you are able to save on costs will directly increase your profit by that amount. The next area that we need to look at is liquidity. Liquidity refers to the ability of a business to pay its debts as they become due. It is very important that you are able to pay your creditors before the due date, and if you need to pay expenses or buy stock, you have the money to do so. If you are not able to be sufficiently liquid, you might end up finding that your business is not as successful as you would like. In other words, we need to look at the short-term cash flow of the business. In order to do this, we'll look at the statement of financial position and compare the current assets to the current liabilities for the period. We will calculate the current ratio, which takes the current assets and calculates it as a ratio to current liabilities. Remember that when you are calculating a ratio, you always want to end up with an answer of something to 1. To do this is quite simple. You simply take the first figure, in this case current assets, and divide it by the second, in this case current liabilities, to give you an answer of something to 1. However, this ratio does not take into account the fact that stock might not sell. It's all very well having a lot of money tied up in stock and having lots of debtors owing you money and not a lot of cash. That will give you a lot of current assets. However, you still might not be able to pay your creditors as they become due. In this case, we then will calculate the asset test ratio, which quite simply excludes inventory from this calculation. This then gives us a clearer, more realistic indication of how easily we will be able to pay our creditors. Keep in mind that if you're not able to pay your creditors, although we might be solvent, we are what is known as commercially insolvent. In other words, you will not be able to carry on running your business. Other things that we need to consider, however, are things like how long does it take the stock to sell? How long do debtors take to pay us? And how long does it take us to pay the creditors? We can't only look at the current ratio and the asset test ratio, as on their own, they might give us an indication that is quite different from reality. If, for example, we sell our stock very quickly, we will be able to generate cash very quickly, both because the stock is turning into cash, as well as the fact that the stock is turning into cash of a higher value than what the stock was originally worth, one would hope if you're selling at a profit. To calculate the rate of stock turnover, you simply take your cost of sales for the period that you are looking at and divide it by the average trading inventory. This will tell you the number of times that the stock turns over, or the number of times that it has to be replaced in that period. The other similar calculation that you can do is you can look at the stock turnover period in days. This is in fact the direct inverse of the rate of stock turnover. We take our average trading inventory divided by our cost of sales and then times it by the period that we are considering. Times 365 if we are looking at a year and want our calculation in days, or times 12 if we are looking at a year and want an answer in the number of months. Ideally, you only want to look at your average trading inventory. In other words, if you are able, exclude any consumable stores on hand or any other type of inventory. The time to sell the stock on hand can also be calculated using the closing stock only. In other words, if you are asked how long do you expect the current stock to last, you use your closing stock in this calculation and you will then know how long it will need to be before you need to buy new stock. We can look at the average debtors collection period, which, if you look at it, is very similar to the stock turnover period. However, we will use the relevant figures for this calculation. We will look at the average trade debtors, and since debtors relate to sales rather than cost of sales, we will look at the sales for the period. Again, where possible, we want to be as accurate as we can, so we will only look at trade debtors before taking any provision for bad debts into account and excluding any other accruals. For sales, ideally we want to know the credit sales figure if this is given. If it is not possible to calculate it, use the total sales figure instead, although this will slightly skew the results. The average creditors payment period is also going to be done in the same way. Again, we will use our average trade creditors, excluding any other accruals, and compare it ideally to credit purchases. Since we don't always know the purchases figure, we can use cost of sales instead. And if we know the percentage that we purchase on credit, we can then calculate the ideal credit purchases. If you are not given this information, simply use the cost of sales figure. One has to be very careful to make sure that our debtors pay us when we want them to and that we pay our creditors when we want them to. These figures are generally very carefully looked at by investors and management alike. However, one needs to keep in mind that you can't always look only at what are our terms and how long our debt is taking to pay us. Although it is an indication of how well management is handling debtors, it is sometimes not possible to get debtors to pay in times of an economic slump. In this case, consider how other similar businesses are doing. We do, however, need to look carefully at our creditors' payment periods. If we exceed the terms that we have been allowed, we may end up having to pay extra interest. On the other hand, if we are entitled to early settlement discounts, we need to do our best to pay on time in order to take advantage of these. This is also an indication of why we want to have good cash flow in order to be able to keep our creditors happy. In summary, when we are looking at our liquidity, for these periods for stock, debtors and cash, if you take your figure from the statement of financial position, stock, debtors or creditors, you need to average it. This is because you are comparing a figure at one point in time to a figure from the statement of income, which is for a period of time. In order to make the comparison more meaningful, we need to use the beginning and end balances from the statement of financial position and divide them by 2 to work out the average for stock, debtors and creditors. If you can remember that we use our financial position figure over the statement of income figure and then times it by the period that we are looking at, it will help you to be able to calculate these much more easily. In addition, we want to keep in mind that to minimize working capital, ideally, we want to look at our stock period and our debtors period. If together these are smaller than our creditors period, we will not have need of much working capital, as in fact, our creditors are then able to finance our stock and our debtors. This is not always possible, but you need to try and achieve it as much as you can. If you have a look here, you can see your operating cycle of how cash turns into stock and how it then turns into debtors and back into cash. If you can keep this cycle as short as possible, you will then be able to pay your creditors much more easily. We now need to consider solvency and gearing for a business. If a business is solvent, it means that the assets are greater than the liabilities and the business is not bankrupt. To calculate this, we will compare the total assets in the statement of financial position to the total liabilities. The illustration here simply shows how your assets are made up of money. In this case, if all that money was borrowed, we would have a very low solvency rate. Hopefully, some of those banknotes were actually invested by the owner rather than borrowed from the bank. This leads to gearing. Gearing refers to how much capital is borrowed compared to how much was invested by the owners. And this can be calculated as a debt-equity ratio. To do this, we will look at how much non-current liabilities we have on our statement of financial position and compare it to the owner's equity figure. Notice that we exclude current liabilities as we are looking at investments in the long term. Owner's equity, however, needs to include our basic capital, in this case for a company share capital, as well as any retained profits, in other words, accumulated profits, retained earnings, etc. Keep in mind that if a business is very highly geared, in other words, that it has a lot of loans compared to own investment, it means that the business has a higher risk of bankruptcy and is high risk or will be seen as high risk by banks, and therefore it will be more difficult to get a loan. The reason that it is seen as high risk is the fact that there's less investment by the owner, and so the owner has less to lose. When looking at solvency and gearing, we also need to consider the return on capital employed, as this determines the actual profitability of a business based on the total capital invested, rather than simply what the owners are earning. This calculation needs to be done by taking the profit before tax and interest on loan. This is because you need to look at the business and assume that there was no money borrowed, or say, if there were no loans, what would the return have been? So that is why we will use our profit before tax and add back any interest on loan. We then need to compare this to our average equity and non-current liabilities or loans. In other words, our average capital employed by the business. In simple terms, the total amount of money that has been invested, regardless of whether it came from the owner or was borrowed. We can then take this calculation and compare it to an interest on the loan to determine whether it is wise to borrow the money or not. This is because if we are able to generate a return on capital employed that is higher than the interest on loan, it means that the business can generate an income and then use part of that to pay back loans, and the rest will then magnify the profits made by the owners. In this case, we would say that the business is positively geared. In other words, it is good to have a loan, and if we are highly geared, that's fine. One can think of it as a very fast car. If you are highly geared, your car is going very fast. If you are positively geared, you are going forwards. And this is great. You will get where you want to go a lot faster. However, if you are negatively geared, the opposite is true. In this case, your return on capital employed is lower than the interest on the loan and will not be able to cover this cost. The owners themselves would have to put money in order to pay off the interest on the loan. We call this negatively geared as it is a bad idea to have a loan. You can imagine this as a car going in reverse. If you are going slowly and you are lowly geared, it is not as dangerous. But if you are highly geared in reverse, you are likely to have an accident. The last section that we need to look at is return on equity. In other words, what are the owners getting out of the business? We want to compare the profits of the business to the investment of the owners. The first one is the return on owners' equity, just like you calculated many years ago. In our case, for a company, however, we need to take into account the fact that the company has paid tax and the owners are not entitled to profit before tax. We will therefore use our net profit after tax and compare it to our average shareholders' equity. Again, keep in mind that shareholders' equity includes retained earnings as well as the initial shareholders' ordinary capital. This is what is earned by the owners on the total investment that they have made in the business. We can then also look at the earnings per share. This comes to pretty much the same thing as the above calculation, except that sometimes owners prefer to look at how much they earn for every share that they hold. We will then take the net profit after tax and divide it by the number of shares in issue. This will then give you a value per share, which is usually expressed in cents. Remember that your calculations are usually based on figures given in rands and sometimes even in millions of rands. You need to take these into account when you are calculating your earnings per share, which needs to be expressed as cents. The earnings per share that is made by a business is going to affect both the market value and the dividends. Remember that the market value refers to how much people are prepared to pay for the shares on the JSE or on the open market. The higher the earnings for each share, the higher amount of money people will be prepared to pay for those shares. As for dividends, one would understand, hopefully, that the more one earns, the higher the dividends that will be able to be paid out. And for many shareholders, a dividend is what really counts, as that is the money that they will get in their pockets. That brings us to our dividends per share. Our dividends for the year divided by the number of shares in issue will give us the dividends per share, again expressed as a cents per share. For both earnings per share and dividends per share, you might consider the fact that if your number of shares has changed during the year, the figure might not be exactly what you would expect it to be. Ideally, one would use the weighted average number of shares, which is usually published. You could calculate it by considering how many shares were held by shareholders for how many months of the year, and then how many were held for the other months of the year. For exam purposes, however, you may simply use the number of shares in issue at the end of the year. Dividends per share is what the shareholders actually receive. This should be compared to the earnings per share in order to determine how much has been retained by the business. Usually, a business would find a specific percentage, maybe 50%, that would be retained by the business for future growth or expansion, and the other 50% might be paid out as dividends. One has to keep in mind that you need to consider what the shareholders are wanting to achieve from their investment in these shares. Are they looking for money to keep every year, in which case they want to get dividends if they are living off this income? However, if they have invested in the long term, they might not be as concerned about dividend payouts and might instead want to see growth in the capital value of those shares. The net asset value per share is calculated by using your shareholders' equity divided by the number of shares in issue to give you a cents value per share. This calculation is not really used much in practice, as in reality, the figure for shareholders' equity on the statement of financial position is based on a number of figures that might not be completely correct, such as what is the value of land and buildings? Has it increased in value? What about goodwill and brand names, etc.? These might have value that are not shown. Also, it doesn't take into account shareholders' expectations of future profits. As such, one would actually generally rather look at the market value of the shares. When you are doing a comparison of a business, you will maybe have to be required to calculate your net asset value. In this case, look at what is the net asset value or the value of the business according to the statement of financial position and compare it to what the shareholders think the business is actually worth. If the price on the JSE is higher than the net asset value, this indicates investor confidence in the business. Or perhaps it shows you that the business might be overvalued on the JSE. Obviously, the reverse is also true. If the statement of financial position indicates a net asset value that is higher than the price on the JSE, it indicates that the shareholders do not have much faith in the future prospects of this company. Consider this cartoon. Although this is a real knockoff of how boring accounting might actually be, hopefully, when you start investigating the financial statements in more detail, you might actually see that they can become very interesting. You will find all sorts of information that might be missed by others, but suddenly will make the situation of the company a lot more colorful and interesting. Consider this cartoon. In this case, what you can see here is that the director is trying to convince the shareholders that the business is not doing too badly, and he refers to it as a seasonal downturn, which should not necessarily be too problematic. However, if you look at the graph, you can see that it is problematic. One needs to be very careful of euphemisms when you are reading annual reports, as the annual reports are prepared by the company and will have the aim of trying to make a company look good. Let's have a look at example 6.4. Over here, you can see the capital and reserves, which are your shareholders' equity, as well as the loan, from Sam's bank. Using these two figures will help you determine the debt-equity ratio. In this case, the business currently has a ratio of 20,000 compared to 290,000. 20 divided by 290 gives you a very, very low ratio of 0,06 to 1. This business is very lowly geared and therefore has a very low risk of bankruptcy. Banks would probably also see this business as very creditworthy. Thinking of our car analogy, this business is driving very slowly and it is safe. We can now look at the return on capital employed. Notice that we are using the same figures as we used for our debt-equity ratio on the bottom of this equation. As mentioned previously, because we are comparing a statement of income figure to figures from the statement of financial position, we need to average the statement of financial position figures. For this reason, we are using the beginning and end balances for both loan and capital and reserves or shareholders' equity. At the top, we need to use our profit before tax from the statement of income, but we also need to add back interest on loan. Notice that we've only added back the 1,800 Rand relating to the loan rather than the total interest expense of 2,000, which might include interest on overdraft or other interests. We are only looking at the effect of what if we hadn't taken out the loan from Sam's bank. Over here you can see that the business is generating a very healthy return of nearly 40%. This is a very good return as it's quite a lot higher than any interest rate that would be charged on the loan. In this case, you could calculate it as approximately 17%, which is very high, by comparing the interest on loan to the actual loan amount, although one doesn't know when the loan changed. We can see, therefore, that the business is positively geared, and the business would benefit from increasing their borrowed capital. If we look at our analogy of the car, the business is lowly geared and so driving slowly. However, the business is going forwards, and so therefore it would make sense to go a little faster or increase the gearing of the business. If you drive in a higher gear, you can go faster. To calculate our return on shareholders' equity, you will need to refer to the statement of income. Remember to use the net profit for the year after tax, as this is the amount to which the shareholders are in fact entitled. This can then be compared to the capital and reserves or shareholders' equity. Notice that in this case we exclude the loan, as we are only looking at the return earned by the shareholders, not the overall return on capital employed. In this case, the company has earned a return on shareholders' equity of 30%. This is quite a lot higher than one could earn in many other investments, and therefore shareholders should be happy with this. An indication of this would be that the market value of the shares would increase, and one would hope that dividends would be paid out in a very favorable manner. To calculate the earnings per share and dividends per share, you need to find out how many shares were held by the business. Over here, you can see that there were 100,000 shares in issue at the end of the year. That will form the base of both of these calculations. However, the difference comes in when we look at what we put on top. Earnings per share is based on the net profit for the year. As you can see over here, it's exactly the same amount that we used in the calculation for return on shareholders' equity of 73,500. This gives us an earnings of 74 cents per share. Notice that your answer would have come out as 0,74. You simply need to move your decimal 2 places to convert it to an answer in cents. Remember also to show the cents. The dividends, however, you are told in the information that dividends of 83,500 were paid out. You show that over here above your 100,000 shares in issue, and that gives you an answer of 84 cents per share. Hopefully you can see that this is in fact rather worrying, as although the dividends might seem quite favorable, if you compare them to the earnings, It means that dividends have been paid out of last year's profits, and you are drawing on reserves in order to keep the shareholders happy. This is not a sustainable situation. To calculate your net asset value per share, you will look at your capital and reserves. Why do we call it net assets? Well, if you think of the word net as always meaning you take something away, assets minus liabilities is equity, and we use our equity figure, in this case, capital and reserves. So capital and reserves, or shareholders' equity, is in fact our net assets. In other words, what assets do we have after we've taken into account how much we owe others? We can now see that our net asset value is 290,000 divided by the 100,000 shares in issue to get a net asset value of 290 cents per share. In order to make meaning of this, you would need to compare it to the market price on the JSE. Now that you've gone through the explanations and the example, you need to try the exercises in this chapter yourself. Remember that after doing each exercise, you need to mark it carefully before moving on to the next one. Have fun.